previous quarters have been really driven by the trading activity, at least in terms of revenue growth. Is that going to be the same for Q1, or do we see another leader here?
Well, we can summarize the quarter as the 5 C's. One would be capital markets, as you point out, but we also have credit quality, we have the return of capital, we have the curve or the yield curve, and we have cost control. But capital markets certainly are stronger for longer, and we think the biggest earnings surprise will come from Goldman Sachs because they are in the sweet spot as the ultimate deal maker. I mean, they've ranked #1 on deals for the last decade. And really, post-pandemic, every industry and every geography has to rethink their business plans. So it's a growth business when you're an advisor, and you should certainly see that at Goldman Sachs and the other big capital market players.
So you've got capital markets, you've got, a yield curve that's working in your favor, you've got economic growth that is poised to accelerate. How much of this, Mike, do you think is already baked into the cake? When you look at the S&P 500 Bank Index, it's already pretty close to all-time highs.
Well, it's all in the framing. I mean, since the start of last year, bank stocks have underperformed the overall market by over 15 percentage points. I do think some of this stronger for longer capital markets is baked in. And I do think some of these releases of credit reserves at banks are baked in. So I think the next stage, though, for the bank stocks are the benefits from the yield curve, which you are not going to see yet in the first quarter. So it's the expectation for loan growth with a more favorable yield curve. And we'll see what that means for traditional bank lending later this year. So to some degree, what the bank managements say will be more important than the results that they show tomorrow and the next few days.
Mike, we saw a lot of stories over the last quarter about executives leaving big banks to work for fintech companies. A lot of consumers have switched, at least here in Europe, to N26 and Revolut. We've got Coinbase starting to trade tomorrow at a $100 billion valuation. Are any of the big players really seeing any material damage yet from fintech competition?
The death of the large bank has been greatly exaggerated. And look no further than the 66 pages, the CEO letter by Jamie Dimon, CEO of JP Morgan. And he talked about that fintech threat. He talked about the tech threat. And, some of the best fintech players on the planet are the likes of JP Morgan and Bank America. Look at their digital banking and how quickly that's grown. Zelle is twice the size of Venmo, and 30% of the Zelle volume is Bank of America. So when you talk about the largest banks, they're pulling their weight. Now, having said that, there's a large underbanked market. There's lots of pieces for many players to gather, and there's a lot to learn from some of these fintechs. But you're going to see, to some degree, you see a survivor bias. The ones that make it are the big players. But I sensed a little bit of anger undercurrent in the CEO letter by Jamie Dimon. And to some degree, we have 20th century financial industry regulation in the 21st century. Banks comprise less than one-third of the financing in the economy, yet the other 2/3 don't have the same degree of regulatory oversight.